Welcome, everybody. If you are here live or you're watching the recording, I know there's people still coming in. This is one of our webinar type of events that we like to do at WellShare that is really there to share with you things that we are seeing out in the marketplace. We analyze a lot of deals. We look at a lot of numbers here. And I want to share what we are learning along the way. I know in our 300 plus investors, a lot of our investors are also active investors. And so it's important, I think, to share what we are all seeing out there in the marketplace and help however we can in terms of information that we are seeing out there. And so I know the CMHC MLI Select topic has been one that's been sort of a hot topic for many years, and likely not that I've ever heard anyone talk about this the way I'm going to talk about it tonight. The goal of this evening is to really be eyes wide open in terms of how the program works, what I think the challenges are, some like stories around things that we have actually been through. Um, I'm also a licensed realtor here in Alberta, and so I've helped clients through it as well from that perspective. And then we've also obviously, gone through it ourselves with WellShare and are looking at deals every single day, which I'll tell you about why they're challenging, and what, some things you can kind of look for and what we're looking for as we move into this year. So, just as a reminder, anything we talk about here this evening is for educational purposes only. I am not a mortgage broker. I am not soliciting an investment here this evening into WellShare. This is for educational purposes only, and I hope it helps you in some way. So that's a little bit about the disclaimer. If you want to review it, you can go to wellshare.ca. So before I dive into the topic, I always like to take just a couple moments and remind you of who we are. And if you're watching this later, maybe you don't know us, but we are a private REIT located here in Calgary, Alberta. We got started in 2022. Really that first year was just kind of getting off the ground. But our mission is pretty simple, is to acquire multifamily real estate here in Alberta. We're also looking at Saskatchewan, and provide a passive pathway into multifamily real estate investing here in our backyard. It's becoming very apparent that more and more Canadians are owning less real estate instead of more, and we try to make it as accessible as possible in terms of reducing the barrier to entry, and also to really be sharing what we are learning along the way, which tonight here is a very good example of that. So education, accessibility, and transparency are our core values and what drives our decision making when we are planning really anything that we do. So that's a little bit about us. I will talk at the very end a little bit more about WellShare, if you do have interest in us, and kind of what we are doing as we move into the next few years. Getting the first few years behind us was a big milestone. At the very beginning, everyone I kind of looked up to in this world said, come back to us in 3 years and tell us how you've done. And I'm really, really proud of what we have done here in the last 3 years. And so now it's about growth mode. So that's what we're excited about. But let's get back to the topic here. Really quickly, on with me tonight, I do have Michael DiPaolo here, who is our investor relations manager. If there's any questions, you have any questions about anything about WellShare, he's here to help you as well. And my co-founders are not here this evening. Rodney, my husband, is out at sports tonight with one of our children. And we also have our board members listed here. The reason I like to highlight this is a lot of our investors are comparing us to other offerings, and I highly encourage you to do so. And really, the team behind it is who is important, not just of the founders, but of the trustees that are making decisions for the entire group. So every decision that gets made at WellShare, there's 6 of us that have a vote. It's not just me making a decision. And so I really do like to highlight that there is a board of incredibly talented trustees behind us that are helping to guide the ship as we grow and move along year after year. So I'd like to just take a moment and highlight our trustees because we're very grateful to have them. Okay, so let's before we talk about CMHC specifically, let's talk about multifamily real estate and why why multifamily, why I see investors eventually thinking about multifamily, the first thing that generally comes up is there's some type of wall in terms of the residential financing space, or they've got, however many mortgages already, and the lenders and banks out there are telling you, no, you know what, that's as much as you can have, and they hit this sort of wall. That's one reason. That's the most common one I often hear about for the majority of people. Now, depending on someone's goals and what they want to do, they often also then think about two things. One is economies of scale, and this is a big one in terms of scalability in a portfolio. So, if you just want to own a handful of properties, that is amazing, and you're, further ahead of many Canadians out there. But if you want to truly grow a, large portfolio, you are going to be looking at multifamily likely in some case. So the economies of scale from a cost per door really is very effective, and it's also a great way to even just build value, which we're going to talk about a little bit more later in terms of how we manage expenses in these financing structures. And number two, there, the net operating income based valuations. This is my favorite part about multifamily real estate is that the value of the asset is determined by the net operating income combined with a cap rate. So, how do we come up with our net operating income? Pretty simple. I'm sure most of us know what that means. And the income minus the expenses is going to give you your net operating income. Now, what is so important about that in terms of management of an asset or how good of a job you do is you do have a direct impact on how well you take care of an asset, how well you make it as efficient as possible, how you squeeze out every $50 in terms of efficiency in your net operating income approach and valuation has a massive impact and multiplier effect when we're talking about our valuation. So that is my favorite thing about multifamily real estate. I love anything in business that the better job we do, the better of a result we can achieve. So that is something that is very different than in the residential world where, your house or your condo is worth pretty close to whatever your closest comparable sale is worth. That could not be more different compared to multifamily, where it really does matter how good of a job you are doing in terms of managing the asset. Now, the access to commercial financing, I like to highlight this, and why it matters is I hear a couple things out in the marketplace and a few things that are misleading. Often I hear, well, I want to go to commercial financing because maybe you don't have good credit, or you maybe you don't have good income right now because you're retired, or you're, for whatever reason, you do not have the income right now to satisfy a residential lender who's going to lend you money based upon your income. Now, that is true and false. Usually people say, well, the asset is going to, qualify, not me as the buyer. And that is misleading. And I do see salespeople out in the industry say these things like this building is approved. All you got to do is just, take it over. And that is very misleading and not true. So, yes, the asset in terms of its performance, they will look at it like a business, which is excellent and what we want, but they will definitely still look at you as the buyer and also what people tend to forget as the guarantor. And so, especially when we're talking about CMHC insured financing, you're putting your assets, your personal assets, your business, or whatever you might have, likely up to guarantee the debt. And a general rule of thumb for that, if you haven't gone down this process before, is they care a lot about your net worth. They are still going to pull your credit. They are still going to want to see that you don't, owe taxes or whatever, that you don't have problems in your financial picture. But they're going to care a whole lot about your net worth. And so one of the first things they ask for is a net worth statement. And you need to show at a minimum about 25% net worth of whatever the loan amount you want to borrow. So if I want to borrow $10 million, I do need to come up with a minimum net worth, and they may ask for more, of $2.5 million or more. And that could be combined with your partners. It could be sometimes I know other groups have guarantors stand in, that is just their role in the deal. But regardless, you will need to have your net worth as part of your picture in terms of how much you can borrow, not just the net operating income or how the asset is performing. So that is the first thing that's really important to understand if you are looking to get into this space. Is that's the first questions that they're going to ask, and we'll kind of determine like what our budget is, right? So I like to point that out at the very beginning. So now, to accompany this presentation, I did make a like secondary guide to this presentation, which is what this QR code is for. If you do want to scan it, likely we'll just send it out to everyone that registered here this evening. But if you do want to grab it now, you can. But from here, I want to talk about what is the purpose of the MLI Select program, and why it was sort of introduced to begin with, why it's such a big feature in the financing marketplace right now. And the purpose of the MLI Select program, when it was introduced, going back about 5 years ago now, was the mandate around increasing affordable housing in Canada. That was a really big one. I'm not sure if you remember back then, coming like post COVID, it was like, we have a huge housing crisis in Canada. There is not enough housing. What are we going to do? There's these big problems. And so this program is a incentive towards builders, developers, investors to increase the amount of affordable units here in Canada. Now, would you say we are in a housing crisis as of today at this moment? That might depend where you live. What has changed a lot since then is the amount of immigration coming into our country. And the numbers are just looking a little bit different today. And rental figures are starting to slide as well, which we expected to do, but is an important thing when our valuations are determined by our net operating income. We're going to talk about that a little bit more later. The second and third mandate for the program was to increase accessible housing and to increase energy efficiency in terms of the products that are being built out in the marketplace. And what you can take all of this as is it is a points-based system, which I think on the next slide I go into further, but that the more that you kind of accommodate these mandates, the more they're going to give you in terms of better premiums, longer amortizations, higher loan to values, that kind of thing. So it's very much a, you get more if you give more kind of thing, but there's always that caveat that we have to think about of what might that mean in the future. So this is what the purpose of the program was. And it was also really intended for multifamily housing, not necessarily single family housing. There's been a lot of investors who were originally using this, like, buying up single family houses in blocks and applying this to it. You can no longer do that. They've made a lot of changes and tweaks over the years in terms of what you can use this program for, but it really was a hot commodity there for a while in terms of the real estate investing community. So I will put that QR code up at the end again if anyone wants it. But okay, so what does the program offer, and how is it different from like a conventional commercial mortgage? So conventional commercial mortgage is very similar to what you're used to, if you are used to, on the residential side in terms of timelines, the amount of money you have to put down. Generally speaking, prior to this program, most common you would hear in Calgary, you'd be putting down for sure 20% as a minimum, but very commonly it was like 25 or 30% is what was required to put down on a conventional commercial mortgage. Now, those are still available today, and I do think we should be reviewing them this year and comparing them to this program and to all other financing opportunities. But this is a very different route. And what piqued investors' interest was the very first one here on the list here, which is high loan to values up to 95%. So what does that mean? I want to highlight loan to value not loan to purchase price. So this is the biggest thing that I could go on a rant on probably every day out in the marketplace. I see marketing for a project or a property, and it'll be marketed as 95% loan to purchase price. That is the first misleading thing that kind of drives me crazy. Now, is it true that you can get up to 95% loan to value? 100%. But what we have to think about, and what we're going to, learn here tonight is how is that value determined? It's not determined by the purchase price. As we said earlier, your valuation is determined by your net operating income and the cap rate. Now, inside of the net operating income, you have all these expenses, right? In terms of how you're going to take care of the property, the obviously taxes and insurance and the basic ones that we all think about, utilities. But then CMHC also has their own things that they want to include in this valuation for expenses, which relate to repairs and maintenance, salaries and wages is one. Even if you are, not big enough that you require a full-time person, they will put a salaries and wage line item on there. Another one is vacancy rate. This is a big one. So, what do we think happens if we know vacancy rate is 3%, but when we go to CMHC and do our, valuation, they want to use 6%? What does that do to our valuation? That is going to bring it down, right? And so you have to think about CMHC is they're the only insurer in Canada for this, a product like this on the multifamily side. In the single family primary home world, that's a different story. But in this world, they kind of say what goes. And they're, of course, trying to manage their own risk as well. So very commonly, the 95% loan to value does not equate to 95% loan to purchase price. And that's the first thing that is really important to point out. My opinion is if you are looking at new construction in this, space at all, really you should be planning for a 10 to 15% down payment on the price of the property. That is more realistic, and is honestly more average. We will talk about that a little bit more after. Now, the second one, what was piquing a lot of people's interest, especially when this program came out, is your interest rate. Your interest rate on a CMHC insured mortgage is driven by the bond market and the bond rate. And so we might ask ourselves, okay, well, the bond rate is constantly moving. How do we determine what rate to use on our pro forma? Um, and that is a very good question, and one of the big challenges and risks with this program. So let's say we're putting in an application today, we can look and see what the bond rate today is. But by time we get our certificate of insurance or actually have that approval from CMHC to take to a lender, of that bond rate could look very different. Bond rate is influenced by all kinds of economical global economic factors that will change the bond rate. And so this is one that has caught people off guard before. And the solution for this is something that's going to require more capital. So if your certificate of insurance or approval from CMHC says you have a maximum bond rate of 4.5%, they'll call it the ceiling rate on there. And however many months goes by, and you're about to lock in your rate prior to closing, and it's over that, you will need to buy your rate down. So that's just one example of where it's really critical to have extra liquidity to tap into should something like this happen. You might ask yourselves, why not lock in at the very beginning? And the problem with that is there generally is a daily rate charge or fee to lock in your bond rate ahead of closing. So typically you're not doing that, 6 months in advance, because that likely would make your deal not make sense. So bond rates are a big one. It is a moving target. It is not like, once you get your approval with your major bank on a residential agreement, you're signed on the dotted line, that's your rate. That's not the case when we're talking about CMHC insured mortgages. So that's a big one. Now, amortization up to 50 years. This one is really important. Now, there is amortization up to 40, 45, or 50 years available in this program. And this is really a big one, and I think more important than the loan to value. Being able to stretch out the amortization to those 40, 45, 50-year period, obviously, as you can imagine, helps improve cash flow situations. And all these three things combined is what was making this strategy so beneficial to investors over the last several years. So those are the three main points in terms of like what is really different in terms of a regular residential mortgage that you might be used to. Now, this point-based system, how does it work? In the guide, there's a little bit more information. You can also go onto the CMHC MLI Select website, and there's tons of information on there. So I'm not going to dive into how you get each point, and your mortgage broker should really be helping you with that. But how the system works is, like we talked about, you can give to get something in return. So let's talk about affordability. For affordability, you need to choose a certain number of units in your project. The more units that you choose to be affordable, the more points you will get. But what does that mean? What does the affordability really mean? The affordability means that you are agreeing to lock these units in for a 10-year period at an affordable rate for that marketplace. So, what does that mean? That number is different for each major city. So, for Calgary, it's 1740, I think it is off the top of my head. So any units we have in the MLI Select program need to be the rental rate needs to be under that 1740. And every year they do ask for a review of our leases and make sure that we are in fact doing what we said we would be doing. And so that is a long period of time to lock that in. And it doesn't matter if you choose it to be a one or two or three bedroom, the max rate is the rate. You cannot charge more than that. And that number is driven by the consumer price index in each city. So you want to look at what the number is at the area that you're looking at. Just because it's X for Calgary, it very likely will be lower or different for other markets. So I know Edmonton, I think, is not quite $200 lower. And so this is what you want to really be thinking about is, I know, like no one has a crystal ball in terms of what things will be like in, a year or 2 years, never mind 10 years or 7 or 8 years, right? And so we did do the affordability points on the very first acquisition we went through on the Bergen, but the other two we actually did not do affordability, and we went for the MLI standard program, which I'll talk a little bit more in a moment. But because I do think that that's just a long period of time to lock something in, not just for us, but what if you need to sell? What if something happens? You're making a decision for a very long period of time. So the energy efficiency and accessibility, those are other points you can add. For energy efficiency, if you're going new construction, you will automatically get points for that. If you're rehabbing an old building and you're improving everything, like the operating systems, the insulation, the windows, all of that adds up. And they use an energy test on your property before you do the work and after you do the work. And there's a whole process and consultant that you would hire for that. And accessibility is a challenging one on an existing building, particularly for doorways, bathrooms to maneuver a wheelchair around in the amount of space that is required. So this works better if you're going to use those points on something that's purpose built. We've tried to look at it for a few projects, and it's just like you would really need to start at scratch in terms of what I've seen. But regardless, there is 3 tiers of the MLI Select program, and you can get 50, 70, or 100 points. So the higher the points, the better the terms likely your program is. At the very end of this, if you guys want me to show you an example, like underwriting that I did on a project that I use as an example on this to show you how much this can change your cash to close, your equity requirement, and how much it'll change your premiums and your debt coverage ratio and all that. We can do that at the end. But all of these factors do change those things for you. And the more points you give them, yes, you will get the higher loan to value, you will get the higher amortization, but you also have, a highly locked in product. I do think it's also worth thinking about and considering, do we need to go up to 95% loan to value just because we can? And I think what we're seeing now in the marketplace, which I will talk a little bit more, is a little bit of fallout from that. And what does that mean when we see rents starting to come down a little bit? So the kind of short story there is the more points you give CMHC, the better the terms that you are going to get. What are some highlights of this? I'm going to talk about the process of what it takes to go through this, what are the steps. I'm going to talk about that next. But just some things that I see out there in the marketing that sort of bothers me. And so just some, I don't want to use the word red flags, but cautionary things is like when you see, buy this $5 million building for 5% down, that is a little concerning because that's not how the 5% is calculated. It's not a down payment, it's a loan to value ratio that is calculated by everything that we just talked about. So that's a very different thing than just a set down payment like you would have in residential. This might be, if someone is using this term or metric to you, just a signal that maybe they actually have not have the right experience with this program. They may not have, gone through it in the way I'm doing here tonight and don't quite understand it to the way that they should if they're going to be marketing this out in the marketplace. The second one there is the building qualifies, or this project is CMHC approved. You as a borrower or buyer, even if you're assuming a pre-existing mortgage that's in place, you do still need to get approved and you do still need to have your net worth requirements in place. There is a covenant that is required to have your, guarantee set in place for you to assume the debt. So even if you're doing an assumption, the building just cannot qualify on its own without the buyer also making that make sense. Just that it's an easy process. Most people who have actually been through this process will tell you it is slow and painful. And the challenge that's been really out there the last few years too is since CMHC is they're the only insurer, really what they, say goes in terms of policy changes, in terms of terms. And so that can make it extremely challenging because what is maybe possible today versus when you're, 60 days in to this process of an application, a policy changes, that can significantly impact your ability to close, your return on your investment, and so forth. So it is certainly not for the faint of heart, in my opinion, and it is something that can constantly be changing and constantly moving. The 50-year amortization, I only hear people talk about the max 95% and the 50-year amortization. We are a big fan of the standard MLI Select program, which means you are doing a 85-15% loan to value. You're getting up to a 40-year amortization and still not having to give any affordability points. So you're not locking in the project for a 10-year period. And I do think those benefits are worthwhile to have to get that little longer amortization. Now, we are looking quite closely this year as well at just standard conventional financing. Considering interest rates have come down, it's getting closer to something you should be looking at. Even though you're only going to get a 25-year amortization, I do think it's worth comparing. So if you're looking at a project, I would compare, them both. So are just a few little things I like to highlight. So, okay. So what is the steps and how do you go through this process? And we're going to obviously talk at a high level here, but usually I hear people kind of lump the CMHC process in with the lender process, and we do have to kind of be aware that these are two different things. So what are the steps? Let's say we have a project that we like. In my opinion, before we should even be writing an offer, the mortgage broker ideally is doing their initial underwriting. And I can show you an example of this at the end if you like, and what that looks like and what we expect it to see, and kind of giving their initial feedback as well on the deal. So with that initial underwriting done, you can at least have some like ROI calculations, some idea of what the financing might look like, how much money you need to put down, etc. They will also give you their best first look at where they think the valuation will land in terms of the project and what it might be worth compared to what the sellers are asking. So that is really good information to have. Um, Okay, so once that happens, we're ready to put in an offer to purchase. And let's just assume, we get it accepted. Great. Now we have our offer. Now, if we want a CMHC insured loan, what is going to happen is your mortgage broker is going to put in the application directly with CMHC. There is a fee associated with that. You can speak to your broker about that. But what now happens is really a waiting game. You're going to put the initial application in, and now you're going to wait to get assigned your CMHC um, underwriter. And this is kind of a long process often. It could be 2, 3, 4 months, depending on what's going on. It has jumped up to 6+ months when there is upcoming policy changes that have been announced. So again, even if the waiting timeline today is 3 months, I think is what we were told last week on a deal we were looking at, then I'm very aware though that if something were to occur in the marketplace, that could shoot up if a bunch of folks put applications in. So this is something you're kind of sitting around waiting for. Now, once you get assigned the underwriter, they're going to take an initial look at everything, at you and your file and the property and your pro forma. Your mortgage broker is also going to make a case for you as the buyer and your skills and what you bring to the table and why you make a good client. And there is a little bit of negotiations here. Now, a little bit. There is sometimes a little bit of wiggle room on things like, what they'll use for a vacancy rate or what they think the rent to be projected at if it's, say, a vacant property. So there could be a little bit of wiggle room in terms of the negotiations here, but it's not like, you can negotiate too much and just, ask for another person, for example. Like, kind of what you get with this individual is what you get. And if you don't like it, you have to start all over at the very beginning if you're kind of not getting what you want at this stage. So this is challenging because if you're not getting what you want here and you're under a timeline, you kind of just have to make the best of it. So often you're likely not going to get everything you want necessarily here. And just a couple examples of things that we experienced, was the last property we bought was completely vacant because it was brand new construction. So we knew what the projected rents were and we thought they were very conservative, but there was definitely some back and forth on that. And the challenge was there wasn't a lot of comparables in the area. And so, this was something we did have to make a case for, but we didn't, quite get what we wanted, but close. And but then they also had a lot of dialogue around vacancy because there wasn't a lot of comparables around. Like vacancy was a bit of a concern for them as well. So there will be some back and forth on that. At the end of that process, a COI will be issued, or certificate of insurance. And this is a document. This is like your Bible now. This is what you must abide by. And it's going to outline all the terms. It's going to outline, if there's a set timeline of when you have to get the property fully occupied by, or what your ceiling rate is. So your maximum rate that you can use for your interest rate driven by the bond rate. And it is only valid for 6 months. So this thing becomes your Bible and what you need to next present to lenders. But I want to take a moment here and think really hard about this 6 months, because this is where I know people have run into trouble. I've seen a lot of posts about it, where they're buying new construction projects that are under construction. And the problem with it only being valid for 6 months is, let's say you put in an offer on something that's going to be complete in, 12 months. you're going to put in a contract today, you're gonna have to remove conditions because you cannot tell the builder to wait, like 9 months for you to get your financing approved. And you do not want to put your application in too early because you don't want your COI to expire by time closing comes. Otherwise, you are kind of in trouble. And so this is one of the very, first reasons we've talked about in this process as to why you always, always, always need a backup plan. You need to know what if this doesn't work out for, a multitude of reasons. Can I live with a backup plan? So we always have a plan B in place. And that could be just a short-term lender. Maybe you get some, short-term investors, or you do whatever you need to do um, in case something goes wrong here. And that is a tricky one when you're on, builder timelines, delays happen, things happen. And I know people have gotten caught in this and have gotten themselves into a little bit of hot water because they couldn't close, or they were only able to close with what they perceived to be a 5% down, right? So any of these issues you run into in this whole process generally mean you need a little more capital than what you thought to kind of solve the problem. But that's a big one, then one to really highlight if you are going through this process. Okay, so after that is done, you are going to then present that COI to lenders. And so you've kind of got your CMHC approval. Now you need to go find a lender that wants to take the file. Again, another round of lender negotiations. The lender may put on extra terms and fees and expectations of what they want on top of the CMHC COI as well. So just because you have a COI, that doesn't necessarily mean the lender's going to agree with everything on there. Particularly if you're new to this, they may ask for more down payment. They may ask for more guarantors. They may charge you a higher rate. They may do all kinds of different things. And so that is a very different process than on the residential side. And then from here, you can think about closing. Now, my opinion on closing is, it's not done till it's done. It is absolutely not done till it's done. We had one story with a major bank in Canada, one of the big ones, who, when this program first came out, said that they were open to doing CMHC loans. And we had all the documents signed right up until a couple weeks before closing. All the legal work had been done with their lawyer and ours, and everything was signed on the dotted line. And a couple weeks before closing, they pulled the file and said that they've decided they are not going to do MLI Select loans. And that was after everything was signed. So these things can happen. It is a lot more, there's a lot more risk, I guess, in terms of closing and things that can change. And there's always something that the lender can change. So beware, really, until it's done, it's not done, and always have that plan B. Again, just talking about the terminology here in terms of, you see this in marketing, MLI Select approved. Like, what does that mean? Does that mean that they actually have a COI issued? I highly doubt it. And if so, whose name is it in, and so on and so forth. So that's why I have a problem with that marketing term. Okay, so just a quick review here. The reality checks I think we all need to be aware of, and how these are going to translate into opportunities and where I see the opportunities for the coming year. Okay, so just a quick review. Loan to value of 95.5 does not necessarily mean loan to purchase price. The COI timeline is 6 months, so caution if you're doing new construction. The building qualifies, but you still need to qualify. The policy changes, they're immediate and they can happen to mid-transaction. If you do not have your certificate of insurance yet, any new changes will kind of come into play that day, like right away. The long-term effects of the MLI Select program, I do think there is some opportunity here, but do give thought to, like, does this match your investing strategy? Do you want to own this thing for a minimum of 10 years? And if you don't, or you think you might not want to lock that in for 10 years because it's going to restrict the next owner and what they want to do with the property. Bear in mind changing variables like vacancy rates. For example, you can go on the CMHC website and get the vacancy rate as it stands for this current area that you're looking at. But a real quick story around vacancy rates here. The first project that we looked at, the Bergen here in Calgary, by the time we had done our initial analysis, and we had that delay with that lender that decided they weren't going to do CMHC insured, and then we got a new lender. During that period of time, the annual change of what CMHC uses for vacancy rates in a given area had changed. And the crazy, crazy thing about this was about a just over an $8 million acquisition. The crazy thing about it was if our property had been like half a block one way, we would have been able to get an extra $1 million in valuation just from the vacancy rate that they used over there. But the one that they used here, even though it was literally half a block away from the other line, they actually increased our vacancy rate because there was some new construction projects around us, and they considered new construction vacant. So even though they weren't complete or up for rent yet, so that one single variable that changed those numbers changed the refinance with the CMHC insured debt by like nearly $1 million. It was very substantial. And I mean, that just meant we had to keep more equity in the project, which was fine. But it also could have swung the other way where we would have been able to take out way more than we were ever expecting to. So crazy little one there about how those little tweaks on the pro forma can have massive impacts. So lenders can pull out, policies can change, rates can change, and COIs can expire. So that's kind of things that are going on in the marketplace. So what does that mean for us as investors this year, and what can we be looking at? Because I mean, here in Calgary and Edmonton, there's a lot of this new construction type of product that has used this program. It works very well if you're the builder as well. Like it's really designed on the construction side to be like at its most attractive. But if you're a buyer and you're wanting to buy something, what are the things that could be happening this year? So let's talk about the first one, which is rental decreases. We're seeing in most Canadian markets that rents have come down in some way, some more drastically in others than, and why does this matter other than the obvious reason? The obvious reason is obviously your valuations or your appraisals are going to come in lower than they would have last year, let's say, if the rents were higher. But that also can create a problem if someone, did take the full 95.5 loan to value last year or the year before when rents were at their all-time high. And now, 2 years later, they need to sell, or something has happened, or they can't close now because the appraisals are coming in lower post construction than what they were originally anticipating. This is a problem now, and these people are, going to require problem solvers. They're going to require, some strategic thinking, some potential creative deal making to happen if they do need to exit these projects. I know here in Calgary, just this past week, I've heard of several interesting stories of why people are needing or wanting to divest of their, 10, 12, 20 unit project that they did take the MLI Select program on. And now, because they have locked in these units for 10 years, it does make it a little more challenging. There's a little less, meat on the bone for the next investor. So that is something that we're watching very closely, but those valuations are coming down, and could be some really good opportunities in there for problem solvers to be able to, partner creatively with builders or whatever it might be, to manage the properties better, to increase the net operating income. Controlling expenses is a big one. There's many projects we look at, and we look at the numbers, and the amount some of these owners are paying for things is crazy, like just like landscaping or how they're doing their utilities, or just basic things that someone who knows how to manage those efficiently can make those valuations and make the numbers look significantly better than what they're doing today. The third one that I know is an opportunity, and we've already had these come across our desk, is people who cannot close because their net worth situation has changed from when they initially made the offer, when they first bought that pre-construction project on that, like 12 plex or something. And now they are unable to close because something has happened in their financial picture. Often I'm hearing in other markets in Canada where their values of their properties have come down or they've lost money or whatever has happened. And so those changes in net worth will impact their ability to qualify when they need to qualify. And that could also require, if you're an investor, you have some net worth, you could come in as a problem solver, get a piece of this deal for literally just lending your net worth to it. And I think we're going to see more of that. And then the last one there is lenders and CMHC continue want to reduce risk in the challenging market that we have right now in Canada, particularly in some of the other markets, but really everywhere. There's a few risk factors out there right now, obviously, and the lenders are a little bit more nervous. And so if they are feeling more nervous, they're going to want more for their programs. And that might mean you need to show higher liquidity to be able to adapt. It might mean they're going to charge you higher fees or whatever it is. So just be aware of those things. But I do think because of all of this, that we are going to see some opportunities the next, like year to 2 years as a result of sort of some, maybe folks who didn't quite understand what they were getting themselves into in terms of this project. Now, if you are just going into this new today, and you are going to go look at a project and you want to go the CMHC route, the best piece of advice I can give you is to make sure that you're being realistic on the rents. Because that is the one that's going to cost you if you are unable to meet those rents and your appraisals come in low. You're going to have an issue in terms of your financing and the amount of equity you need to close. So being really realistic with those numbers. A very good mortgage broker will be able to help you with that as well. They have internal like valuator teams that are constantly looking at the data to make sure that you're going to succeed. So having a broker that does a lot of these deals is really, really critical. Okay, so what I want to highlight here, this is the assets that we have right now. We're currently looking at several deals right now on the table of apartment style and townhouse projects. This can work for either type of property. It doesn't need to be just apartment style projects. Now, if they are townhouse projects, there is some restrictions. If they're individually titled, they need to be attached. This one is attached here, but your broker can help you out with that as well. So this is the types of investments that our investors are taking advantage of here at WellShare. So I'm just going to spend a couple minutes here just talking about WellShare, and then I'm going to take your questions and show you that document if you guys want. But just as a reminder, like why investing with WellShare is being able to tap into our management team and the expertise that we have to get your money to work for you, your cash or registered funds, minimum of $5,000 or more to invest with us. It's a very attainable way to join our community, be a part of what we're doing, and dip a toe into this space without having to go it alone, and to still get the exposure to the Alberta market, but also the asset class of multifamily real estate. We do target a 12% annualized return, and I'm sure Michael has put up the link in the chat. We are just like moments away from releasing our third year of financials in the next couple of days. Those will be posted to your Atlas one for any of our investors that are on here. So this slide will be changing as soon as those go up, and we look forward to doing that. Our first year we did just over 11.1%, and we only had about 9 months. And last year we exceeded over 12%. On our returns. This calendar year, we're actually changing our valuations to occur twice a year instead of once a year, which is really great for you as an investor for more transparency to see what's going on. Every 6 months, you're now going to get a look at that, as well as more compound growth. So instead of just one, let's say 12% change per year, breaking that into two sixes and sixes is going to be even more beneficial for our investor for compound returns. So something we're very excited about and our investors have been asking about since day one. So that's a big change. It will happen this year. Um, and if you are interested to learn more about us, Atlas One is our exempt market dealer, and I'm sure the link is there in the chat. And they're there to honestly guide you in the right place when it comes to your passive investments and to answer all your questions in terms of passive investing and using your registered funds and all of that to invest in things like Wellshare or all the other things that they have on their platform. You can go check out Atlas One. Okay, I'm going to pull up the chat here and see if there is any questions about anything I've talked about this evening. Does anyone have any questions about the CMHC or MLI Select program or anything I kind of went over? I know there was a lot there. This QR code is for the guide as well. Was that helpful? Were you surprised by anything? I'd love to know kind of any feedback. Was there anything that, kind of stood out that I said? Good question. If MLI Select goes sideways, does condition get terminated? So yes and no. So it depends how your contract is structured. If you have a purchase contract that gives you enough time, like say 4 months to get a CMHC insured approval, then yes, you're okay. You're not going to remove conditions. You're going to say you did not get approved, and you're going to walk away from the deal. You're going to not waive during your condition period. However, as I just said, though, you could still get your COI and your lender approval, lender approval, and something could still, even with those things, we've had things change between that approval and closing date. On that last deal we did in Stillwater, even though we had both of those things, we still needed a little bit extra cash. So they, always have a little bit more money to put down than you think. And now, but where people are really getting into trouble is if they're buying new construction, even more so. It's less of a risk on the resale properties, but let's say you are buying something brand new. The reason it's challenging there is because the timelines are so long. um, the 6 month period, let's say, to get a full approval and lender approval is shorter than it's going to take to build the thing. So it could take them 12 to 18 to 24 months to build this. Often the builder is not going to, let you tie up the project for a full, you know, 18 months, let's say, because you would need that period of time because you can only get your COI within 6 months of completion. So the challenge is the builders generally are not going to give you that time back in terms of like having it conditionally sold for that period of time. They're just not going to. Um, Judy says, so we did do the MLI standard. So the MLI standard is the 8515 CMHC insured program. So sorry if I wasn't clear on that. We just did not go the full MLI select. So for our investors, we have a lot more skin in the game in terms of equity. We can, adapt if we need to a little bit better rather than pushing the leverage really high. But also for townhouses, capping our rent at 1,700 does not make any sense. So we did not want to give any affordability when our townhouses, rent for $2,500 to $2,700 each. So for townhouses, generally you wouldn't do the full MLI Select anyway. But so we did 40-year amortization and the 8515 loan to value on those. And I think that's the sweet spot. I think it's okay to have a bit more money down. I think, the affordability issue it's a good one, but it's also, it's going to be a bad one if you decide you need to sell this project because the next owner may not want it and they are required to assume it as well. So you're kind of making a decision for the property for a long period of time. You gave an example of a big lender who pulled out 2 weeks before close. Uh, Once closed, no, the lender cannot back out once it's closed. I mean, unless you violate one of your terms of your lending agreement, like you don't provide them the annual financials or the net worth requirements on an annual basis. The guarantors of the mortgages, generally speaking, annually do need to provide updated net worth statements. We just had to do that here in the last couple weeks. They usually ask for that a few months after your year end. And so if you do not meet any of those criteria, they could call the loan. If you're charging more on, units that are supposed to be affordable than you're supposed to, that could be another reason. So you just got to make sure you're following your terms. Otherwise, the lender could back out. And then if that does happen, you're kind of going to be in the bad books with CMHC, probably moving forward. So that can make any future projects very difficult. Good question, Simon. So you do not have to do all the units. I actually might pull up that little spreadsheet here to show you the difference. You get to choose how many units you want to lock in. Obviously, the more units you lock in, the more points that's going to give you. To get the full 100 points, you absolutely have to use affordability as well as energy efficiency. You could use accessibility as well, but you have to use affordability. So there's no way to get around that. But maybe I'll just pull up this little chart if anyone is interested. If you have to run, that's no problem. But it shows the differences in terms of the points as well as the equity requirements. Now, this example I'm going to show you, I don't know why I've been using this one as an example for a while, but I have. It's just like something I got approval from the broker I could use as an example. It's probably 18 months old now, but the point of it is just to show you the variable. Don't get too hung up on the numbers or whatnot because they'll change with every deal. And this is a little old, but what I want to show you, okay, let me share here and I'll zoom in once I share it. Okay, so this is by Green Birch Capital. They're a group here in Alberta that do a lot of CMHC approved mortgages. If you ever need an introduction to them, let me know. I do have a good relationship with them. And what I like about them is they're not afraid to do this work up front. So this was just for I think it was like only like yeah, this was just 5 townhomes. So this was not a big deal. That's the other thing about these programs is when you are a smaller deal, like anything under $5 million in terms of the debt, they consider that a smaller transaction. A lot of the lenders won't necessarily do them and they'll charge you higher fees because it's smaller. So the lenders will often tack on a bit higher percent for the smaller transactions. But really what I want to show you here is this is what I expect as a buyer or as a realtor that the mortgage broker should be providing to us before we even write an offer. So in this example, we would have sent some information about this ahead of time that he received in terms of like rental rates and that kind of thing. But what I want to highlight here is two things. On this middle part here, obviously we have the projected rent and vacancy expenses. As you can see here, it's derived from Calgary Zone 6 Northwest. So they went and looked on at the time. This numbers will be higher now. At the time, these were numbers that were on the CMHC website for this particular zone. So they were accounting for a 3% vacancy rate. However, when you get to that CMHC underwriter, if between now and then, and their opinions that it should be 4%, then they might make it 4%. So just because it's 3 here, this also isn't guaranteed. This is just their best guess at the time. The other thing to highlight here is the expenses. And as you can see, maintenance and repair and appliances, they do have a per unit per annum, a per appliance per annum for things like that, and then a percent in terms of salaries, management, and other costs. And these are things that it's there. That is going in there whether you like it or not, whether you're self-managing, and often they won't even let you self-manage, to be honest with you. But what this is going to pop out in terms of the points we were talking about here. So we got our affordability, our efficiency, and our total. Now, what I want to show you is how to get this out of the way so I can only see me. Okay. What I want to show you here is on the left, it shows total points. So there's a variable here for affordability. So if in this example, if we chose to give 50 points for affordability, which would in this case probably would have been just 25% of the units, or up to 50 or 100, obviously it goes up. The total points will either be 50, 70, or 100. And that will immediately affect the max amortization that you can get. So at 100 points, you can see you need to get 50 years amortization. Well shared, the last two acquisitions we did, we're sitting at this 40-year amortization. And then you can also see it's going to pump out this interest rate ceiling. So all of these things, of course, will significantly impact way over here to this side, our equity requirement on the right. Just in this example, look at how much these numbers change, right? We're talking about the lowest equity requirement, I think, is 173,000 all the way up to 630,000. That's a big swing in the cash we need to close in terms of equity, depending on which points you use and how you take advantage of the program and how much you give CMHC. It's also going to change the premiums, the debt coverage ratio, and all of these other factors that your mortgage broker will work with you on. I'm not a mortgage broker. Obviously, I'm not trying to advise you on that. I'm just trying to show you the kind of the strategy behind this of what you need to expect if you're looking into one of these projects on your own. And this helps a great deal. And your broker will, when they get back to you, say, like, you know what, this is probably what makes most sense for this project. And then you can go and see if that makes sense for you before you even write the offer. Down, yeah. Oh, yeah, down. So equity requirement is just your down payment. You'll have your legal fees and other expenses on top of that, lender fees, legal fees. So this will just be for your like down payment component. Are all and we yeah. So the Simon, the if you go on the CMHC website, it'll break it down for you really well in terms of percent of units locked in and how many points that gives you in terms of the program. The other example that happened to us in terms of stories is we did have the bond rate spike above the interest rate ceiling as well. And that was something that you are at that point, you're committed because you've already removed conditions. You've already gotten to the point to closing, and something can happen in the world and spike the bond rate, a few days before. Prior to closing, it's kind of an interesting time because you'll be really in communication with your broker kind of daily to go, what's the rate doing? Should we call and lock in? And you essentially sort of call and tell them to lock in right now, and that's it. So you're kind of watching really closely for those few weeks before closing what the bond rate is doing. And then from the moment you lock in, there is a daily fee to be locked in. So it becomes something that's a little too exciting they don't necessarily want, like that's very stressful. So you kind of got to be really conservative with your numbers, conservative with your bond rate. If you do better, great, I mean, amazing. But what you don't want is to be much higher than you originally like ran your numbers at, and now things are not looking anywhere near like what they should. So being really conservative is a real critical component in this. And one, of our big secret weapons at Wellshare is Monique, because she's very good at this side of what we do, and being really conservative with our numbers and our math, and kind of mapping out, worst case scenario, can we live with it? And what is plan B, better scenario and best. And we kind of got to make sure that we're okay with all three and we can still hit our targets. So yeah, I feel like I talked a lot there. I hope that is somewhat helpful. The only other thing I was going to show you real quick, if you are out there and if you are looking for a mortgage broker or a realtor as well, please let me know. I know a lot of folks all over the country that do this well, because you really want someone who is doing a lot of this, and you want someone who is working closely with a mortgage broker. So remember how I said this only other thing I want to show you um, was before we write a purchase offer on a property, you want to know from a valuation standpoint how the lender and CMHC are going to look at this when it comes time, as best as you possibly can at that time. And along with that other document I just showed you, this is what also Green Birch puts together to determine a rough like appraisal of how the property should appraise and what the value should be, because we care a great deal about that. So this goes along with the other one where it has projected income, all the expenses, and how they think it's going to look on an appraisal. So as you can see here, they're using a cap rate with the net operating income to give us an estimated value of this asset. Now, I will say cap rates. If you ask Monique about cap rates, she'll kind of roll her eyes because they are slightly influenceable to a point, depending on the appraiser. This is not a set in stone thing. You can now to a point, you can't swing them hugely, but the number that they put here is important. So this mortgage broker, though, it's good to get, their opinion. In this case, the purchase price for this project was 2.828, and Green Birch's valuation came in at 2.9. So, if you see that the other way around, you're a little bit upside down. The better this looks, the better for you. The more you have in your valuation, the higher your debt is going to come in terms of CMHC and the amount that they're willing to loan you. So ideally, you want your purchase price under this valuation price, which is what we absolutely must have on every acquisition that we do. So this is just like a quick couple things to look at immediately is the valuation, where do we think it's going to come in at, combined with what those different factors might look like on the MLI Select program if we are in fact going with that program. So I hope that helps a little bit. If anyone ever wants a copy of one of these things, I'm happy to share it as well, or introduce you to the team over at Green Birch. But I went over a little bit. Hopefully that was helpful. As always, if you ever need anything, please reach out to us or the Wellshare team. We're here to help you and, point you in the right direction of whatever you might need, if anything. But if not, always great to see everyone and have you on our webinar with us here this evening. And I hope everyone is starting to enjoy springtime.
Thanks, Natasha. That was really helpful.
Good. I hope so.
Yeah.
Have you heard
Yeah.
anyone
Good to
talk
get an
about?
update because I haven't,
Yeah, you've
not
been
that I'm planning to purchase anything directly myself, but interesting to see how, the approach that Wellshare is taking with it.
yeah,
And, as an investor, I feel confident with how you're doing it and mitigating risk as best you can by going with the
yeah,
regular CMHC
yes.
mortgages. And this is probably a really tough question to answer, but I'm just wondering in general, are you hearing that the interest in, the original MLI Select, where everybody, as you say, was um,
Everyone's
enticed,
excited.
I guess,
Yeah.
by the so-called
Yeah.
95% loan to value. Do you find that investors are backing away more from that, or is there still as much interest as there was, say, even a couple of years ago?
I think there's less interest. I think there's some, oh, thank you so much. I think it's more of a caution and like, let's take a look at everything. Like, what are all of the options rather than we only want to go this option
Yeah.
because it's kind of what's the trendy thing. Like, there's always a trend of what is kind of making sense. And to your point, I think smart investors, and I like to consider us as smart investors over here and managers, is last year, especially, really moving into this year, it's making more sense, but it was better not to buy anything. because the performance were so high. Everyone's rental rates were projected so high that if you buy into those, and next thing you know, a year later, your valuations have actually gone down because you are only this
Hmm.
thing only works at the highest. You're better off not to buy in this commercial world of things, right? Residential is very different, but when you're talking about commercial lending, you do need to think about that really carefully because, well, especially if we do annual appraisals, right? We want to see growth, not loss. Like that doesn't make any sense. So we're better off to do nothing. We looked at so many deals and all of them, I was just like, there's no way these rental rates are going to be here next year. And sure enough, we're right. And so some of those deals are now coming back around this year with a lot more attractive price point, right? So that's just being really smart and patient and not, getting involved when there's a frenzy of, something like it's usually if there's a frenzy, I'm going like it would, let's look around the other way kind of thing. Because yeah, there's, and it's just one of those things like, is it too good to be true? In many cases, it was marketed that way. It has its place and it's done a lot of excellent things. And I think there's been a lot of projects that have helped what it was intended to do. But I think there was also just a lot of maybe smaller investors, especially that did not quite understand what the worst case scenario was or what the risks were, which is what,
Hmm.
why I wanted to do this presentation.
Yeah.
But I also think there will be opportunity this year because of those. So,
Yeah.
yeah, I appreciate that though. I appreciate the comment and yeah, seeing you because I know you've been so busy, but it's good to
Yeah,
see
good to
you.
see you too.
Yeah. And yeah, hopefully everyone learned a little bit of something. Ken, did you have anything? No.
Nope, nope. I was just glad to sit in and listen.
Awesome. I appreciate it. Well, I always like having a couple cameras on. It's always nice to see some faces of who's here. But yeah, we will wrap it up. I know we've gone quite a bit over time here tonight. But again, if anyone needs anything, please let us know. We are here. We are here to help, and it was so good to see everybody.